So we've received a lot of comments and inquiries, questions and concerns about, a lot of clients and prospective clients and people in the community that are fearing this eventual market correction or crash. And sometimes to the tune of, a story that we've heard is like, we've heard that it's going to be 70% pullback or it's going to be the worst recessionary period of all time. And although no one ever knows what the future is going to bring, and nobody could certainly predict COVID and what effects that would have, like it did the spring of 2020. But nonetheless, your portfolio strategy should really not change regardless if you are, have the potential to run into a severe market correction. Now, why would it not change? Because it's just like trying to insure your house while it's on fire. You have to make sure that you have your assets invested so that you can withstand both market drops and then also surging markets. Because too often we hear clients make drastic changes to their portfolio, sitting in cash, reducing equity exposure that is unnecessary, or being too conservative, and then what happens is the market actually continues to surge higher. We've probably heard that there's going to be colossal crashes 4 or 5 times in the last 5 years. And yes, the COVID crisis did create a bit of market volatility, but you saw what happens with the recovery. Markets are extremely versatile. Now, what that means, though, is you do not step into 100% equity exposure or trying to squeeze every drop out of an elevated market. You have to make sure that you're diversified in asset classes that will both protect you in the downside but still provide return. And like a broken record, we'll continue to review these. It's going to be private equity, private debt, private real estate, private mortgages, and different alternative assets that have no correlation or very little correlation to the market. Meaning that if you do get a colossal pullback in the markets, your portfolio or that portion of the portfolio will not be affected. In fact, in March of 2020, virtually 70% of our portfolios for clients were not affected or went up in value extremely. So when you run into that volatility, not only are you protected, but you're actually continuing to make profit and have your portfolio grow in the right direction. It's not about being fancy. It's not about being, new age. It's just the true way to invest if you are a wealthy and astute investor. And so what that means is if you're a billionaire family office, you're going to have these types of assets inside your portfolio. If you're a large endowment fund or you're a pension, even like the Canada Pension Plan, they always have these types of assets. That's why they garnish the most consistent returns in the entire investment industry without being exposed to crazy market volatility. So just because you are stepping into these alternative assets does not mean that your portfolio will not see successful increases and consistent growth that we're forward. And so that's why it's always a big priority of ours to make sure that you have those types of assets, especially if you are concerned about having a serious pullback. But nonetheless, you have to still have that equity exposure, because if you're wrong and the market doesn't pull back and it continues to go higher, you may never get another entry level lower. As an exaggerated event, if you think about not investing in 2008 and you sat in cash, yes, you missed the 2008 financial crisis crash, which was probably one of the worst and the most sustained market volatility sessions of all time. But nonetheless, even if you invested right at the peak and you look at where you're at today, it's a remarkable difference. So you always have to be long the market, but that doesn't mean you have to invest only in the market.